What is the difference between Canadian rental income and capital gains for non-residents? Many non-residents earning income from Canadian property are surprised to learn that not all real estate earnings are taxed the same way. The Canada Revenue Agency, CRA, draws a clear line between rental income from ongoing rent payments and capital gains from selling property. Understanding this difference isn't just an accounting technicality. It can determine how much tax you pay and what forms you must file. Let's break it down. Rental income, regular earnings from rent. When you lease out your Canadian property, whether short-term or long-term, the CRA considers that income to be Canadian source rental income. Key features of rental income: taxed under Part 3, withholding, or Part 1 if you file under Section 216. Eligible for expense deductions, mortgage interest, property taxes, insurance, etc. Must be reported annually through an NR6 form and Section 216 tax return. Rental income is considered active income and you're taxed based on your profit after deductions. Example, you earn $36,000 in rent per year and spend $24,000 on expenses. Your taxable rental income is $12,000. This is the ongoing recurring income that makes up the bulk of non-resident filings with the CRA. Capital gains, profit from selling property. If you sell your Canadian property for more than what you paid for it, the profit is called a capital gain. Key features of capital gains: taxed under Part 1 of the Income Tax Act, not Section 216. Only 50% of the gain is taxable. Calculated as selling price, purchase price plus selling costs plus improvements. Example, you bought a condo for $400,000 and sold it for $500,000. Your gain is $100,000 and you're taxed on $50,000. Unlike rental income, capital gains are a one-time event. Withholding and clearance certificates. When a non-resident sells Canadian property, the CRA requires the buyer to withhold 25% of the sale price and send it to the CRA unless a certificate of compliance, Form T2062, is obtained. This certificate confirms that you've reported your gain correctly and reduces the withholding to 25% of the gain, not the full sale amount. Without this certificate, the buyer must remit 25% of the total price, even if your actual profit was small. Common mistakes to avoid: confusing rent with sale proceeds. Both are taxable but under completely different rules. Failing to file both. If you rent and later sell, you may owe rental tax and capital gains tax. Ignoring reporting obligations. Even if you made a loss on sale, you must file to document it. The key takeaway: rental income, SARTs, taxed on ongoing profits. Capital gains, SARTs, taxed on final sale profit. Both are taxable in Canada for non-residents, but knowing the difference helps you plan, file, and save strategically. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.